Hello and welcome to the Socially Responsible Investing Cooking Show. My name is Hendrix and I'm an investment advisor with Balanced Rock Investment Advisors. And today I'm going to be talking with you about how to shift your portfolio towards better behaving companies while making a fruit salad in my neighbor's kitchen with the fruit that I happen to have in my refrigerator before I go on vacation. Okay, so the first thing I want to say about this recipe is it's really easy to implement. It's kind of the low-hanging fruit of socially responsible investing. It's really easy to take these first few steps to shift your portfolio towards better behaving companies without sacrificing any financial returns. And part of that is because we can still select low-cost investments and maintain diversification through this strategy. There's further steps that you can take that are more difficult, but this first step is a really big step and makes a big impact, and it's really easy to do. So that's the upside. The downside is that it's not going to be perfect. It is the first step, and it's really more a strategy about taking out the worst actors from your portfolio rather than only investing in the best of the best companies. The other downside is that if you have all of your assets in a 401k, 403b, or other employer-sponsored plan, then it's going to be challenging to implement this since you only have a limited set of options available to you in your plan. But if you decide to leave your employer at any point, you can always roll those assets over into an individual retirement account and then have access to the world of investments. So the first step that I want to talk about is investment cost. So that's one of the ways that we can implement what's called an ESG strategy, environment, social, and governance strategy, without sacrificing financial returns. So there are two different kinds of mutual funds, two broad buckets of mutual funds that I want to talk about. And a mutual fund is an investment vehicle that holds many different securities so that you can invest in a diversified way without having to go and pick all the stocks and bonds out yourself. So there are two buckets. One bucket is actively managed mutual funds, which tend to cost a bit more. And the other bucket is passively managed mutual funds, which are more cost efficient. So actively managed mutual funds, it is what it sounds like. They're more expensive because they're hiring somebody to do research on companies and pick out the companies that they want to include in the portfolio. With passive funds, the companies in the portfolio are based on an index, an automatic generated list of companies based on purchasing companies in a certain asset class or of a certain size. And on the whole, actively managed mutual funds do not tend to do better than their passive counterparts and are more expensive. So when you're investing in actively managed funds, not all the time, but a lot of the times, all you're doing is dragging down your return. So in this recipe calls for limes, and this lime is 10 cents. This lime is $2. So costs of mutual funds do range widely, but that's a typical difference that you'll see between a socially responsible index fund and an actively managed index fund investing in very similar companies. So instead of using the $2 limes for the salad, we're going to be using the 10-cent limes for the salad because we want the salad to be affordable. Okay, so get rid of that. The next step is diversification. All right, let me get my last one next. All right, so now we're going to construct your salad portfolio. These apples are going to represent the stock side of your portfolio. So we're gonna cut these up. You're gonna have different types of stocks in your portfolio. You might have like mid-cap, US mid-cap stocks, or large cap stocks, or emerging market and developing market stocks, or other types of stocks. So that's the stock side of your portfolio. And then this mango is going to represent the bond side of your portfolio. And again, you're going to have different types of bonds in your portfolio. So you might have short-term bonds, intermediate-term bonds, long-term bonds, high-yield bonds. So we're going to stick these bonds in your portfolio. All right, looking diversified over here. And so this is a conventional apple and a conventional mango representing a conventional portfolio that's broadly diversified. And you could pretend, yeah, like these are different stock asset classes and different bond asset classes within this fruit salad. Okay, so to make this a little more interesting, we are going to then use this lime to swap out some of these conventional investments with socially responsible investments. And so what you want to do is find a investment that is very similar to an investment that you have in your conventional portfolio that represents a similar types of companies in a similar asset class. So I'm just going to say that pretend that this conventional apple slice is a conventional US large cap index fund or mutual fund like S&P 500 or something. So I'm going to take that out and I'm going to put in its place a socially responsible lime that is also invested in US large cap companies, but is only invested in the better behaving, in the top 50% of well-behaving of companies that are rated along the lines of environment, social, and governance factors, ESG factors. Okay, so we're gonna swap that out. Let's also swap out, let's see if we can find an emerging market fund. And it's possible that there are some asset classes that you just can't find a socially responsible option in, just because the product field has not developed as much as we would like quite yet, but it's getting there. So you might not be able to replace everything in there with what you want. So the other thing we want to do is, of course, replace some of the bond side of the portfolio. So we're going to replace some of the mangoes with a socially responsible cucumber fund. Let's get this out of there. Let's pretend this is like a intermediate bond fund. And then let's do a little bit more. Again, let's replace like short-term bonds or something. So we may not be able to replace all the conventional mangoes in this salad with socially responsible cucumbers because, again, the product landscape is just not fully developed yet. There may be, for instance, a high yield bond fund that is socially responsible, but it may not be in the cost spectrum that you're looking for, or you may be willing to sacrifice some of your returns by paying higher costs for socially responsible funds. That is your choice, but it's also perfectly fine to have a mix if that's what you want to do. Have some conventional in there and some socially responsible where you don't have to make compromises in terms of cost. Okay, so where can you find all these ingredients? I would recommend looking for ETFs and index funds with providers that do focus on low cost. So you can find some good ones with iShares, which is owned by BlackRock. You can find good ones at Fidelity, also Vanguard, but do your own research. And the two most important things to keep in mind are cost and maintaining a diversified portfolio. So there's lots of tools for creating a diversified portfolio online. Also, of course, we're happy to help you at Balanced Rock. So if you want to schedule a time to meet with us, we're perfectly happy to do that as well. Okay, next and our last step, we're going to do something kind of wild, which is go a step beyond conventional, shifting from conventional to ESG, socially responsible investing in public markets, we're going to actually take out some of the portfolio and replace it with impact investments. So this is where we start getting into socially responsible investing, where you really can compromise returns if you want to. And there's lots of people who would actually, encourage you to consider compromising returns. The nice thing about investing is you get to put your money somewhere, and you don't even have to do anything, and it just makes money for you. You barely have to lift a finger. You just like click a button, and it starts making money for you over time. So plenty of people who would encourage folks to think about doing impact investing and sacrificing returns, but many of us are not in that situation where we can afford to sacrifice returns, and that is perfectly fine. So one of the easiest ways to get started with impact investing is to check out some of the community development financial institutions, CDFIs, in your area, or just ones that you're excited about nationally. So CDFIs are nonprofit funds that invest in affordable housing, small businesses, cooperatives, sometimes alternative energy, and make those investments in low to moderate income communities. And many of them offer investments to individual investors. And so that can be a great way to start doing impact investing. It's a lot easier to invest in a CDFI, which are often available to people regardless of their net worth, than it is to invest directly in a small business, which may not be available to everybody, and also which is just a single one-off investment. Whereas when you're investing in a CDFI, it's a diversified investment because they have their own portfolio that they're managing. At least most CDFIs do not have any investment costs. There's no expense ratio. So yeah, and it could be a great thing to develop a relationship with a CDFI, even though you can't have your traditional custodian hold those investments, so you do have to keep track of them yourself. Okay, so what we're gonna do, I think, is, we said the cucumber was a socially responsible intermediate bond fund. So we're gonna cut that in half and replace half of it with a CDFI investment, maybe like a five-year note in a CDFI that's financing affordable housing. And then over time, we can continue swapping out pieces of the portfolio for ESG, conventional to ESG, ESG to impact, or conventional to impact. One thing that I would caution people about is not having too much of their portfolio outside of traditional public markets, because it's a lot harder to assess risk. It's a lot harder to be diversified, and it's a lot harder to get a market rate portfolio if that's something that you're looking for. So generally, we recommend no more than 10% of a client's portfolio in impact investments. Again, if you're interested in learning more, please schedule a meeting with us. Happy to chat, regardless of whether you decide to become a client or not, and you can schedule that right from our website. Where can you learn more about CDFIs? I send folks to the Opportunity Finance Network, which is a network of CDFIs around the country, and you can find what CDFIs are in your area locally. Okay, so hope you enjoyed this video, and buen provecho.